All right, guys, bang, bang. I've got Darius here. Darius, I figured a perfect place to start would be with the Federal Reserve. Mr. Jerome Powell came out, his famous 8-minute speech that shook the world. What was your take on his latest comments?
His latest comments very hawkish. I mean, you don't need me to tell you that. I think this is something we've been talking about in our research at 42 Macro, which is we are entering the third phase of the U.S. monetary policy regime. The first phase was characterized by a Fed that had to catch up to market expectations of tightening and ultimately sort of, accelerate that process to kind of get in line with market pricing, market expectations, et cetera. The second phase of monetary policy was the market moving ahead of the Fed again to say, hey, look, all this tightening that you're doing is going to cause a significant downturn in the economy. And eventually you're going to have to pivot. Initially, the pricing was sometime in the early part of next year to rate cuts and probably quantitative easing. Now I believe we're in this third phase of the monetary policy regime, whereby the Fed officials are talking out that speculative rate cut pricing from 2023, money markets, et cetera, because the Fed understands that in order for it to achieve its inflation objectives, they have to remain tighter for longer. And that's the new narrative around markets. It's tighter for longer. And what does that mean?
So basically, the market was like, oh, cool. You guys said you were going to tighten. You did it. You can't keep tightening too much. So like at some point, you're going to have to pivot. Because we're forward looking, let's go ahead and position ourselves for the pivot. And the Fed basically came out and was like, you guys are all nuts. We're going to keep doing what we're doing. Can they keep doing what they're doing though? Like they're saying it. Can they keep doing it?
I think this is the most important question of the day. The most important question of the longer term outlook for asset markets is whether or not the Fed will eventually start to acquiesce to more inflation pressure in the system by not sort of constantly fighting it and trying to get inflation back to their 2% target. The most important question of today, kind of the medium term, that's more of a longer term view. The medium term is, can the economy handle it? And where is the neutral level of the policy rate? Go back to July, the FOMC meeting, where Jay Powell said effectively that, hey, look, we think we're finally towards right around neutral from the perspective of the policy rate, which at 2.5% is their estimate of long run neutral, which, if you ask any economists worth their shirt, obviously Larry Summers is kind of being the guy out front on this. 2.5 is not neutral in this new U.S. economy, whereby any measure you look at from a wealth effect perspective, stock market capitalization perspective, income inequality, the booming labor market, there's very clearly a lot of organic nominal growth potential in this U.S. economy. And so the key question is, will they break something? And at what level of interest rates will they break something? Clearly, they have not broken anything yet, as evidenced by this morning's JOLTS data and consumer confidence reports, gangbusters data.
So when we look at that whole idea of like, they're going to have to break something, people have been saying this for a while. You and I have talked about it a number of times this year. A lot of folks looking at their investment portfolio being like, sure looks broke to me. Like this stuff is down a lot. What are you talking about when you say they have to break something? It's obviously not the investment asset kind of prices. It is these other data points. What do you expect to break? And they'll kind of be the canary in the coal mine as to like, okay, we're getting close to some sort of pivot.
Yeah, well, the question is, I mean, they've done a decent amount of damage to investment assets, but let's not forget the starting point was basically a bubble in the stock, bond, and cryptocurrency market. So, taking a little bit of air off taking a little steam off those bubbles doesn't necessarily mean that we've broken anything. I mean, obviously, S&P right now, inclusive of today's decline, is still only down like 15 or 16% from its highs, from a very asymmetric all-time high, obviously. So it's not really saying it's broken anything. What I mean by breaking something specifically in the economy specifically is the labor market. This is a U.S. labor market we've talked about many times on the show that is growing at rates that are effectively double our pre-COVID trends. If you look at private payrolls growth, on the 3-month annualized basis, double average hourly earnings growth, double private aggregate private sector income, more than double the pre-COVID trend when you productize all those different features and factors. So this is the labor market as evidenced by the JOLTS data that we just got today, accelerating another 200,000 to 11.3 million or 11.2 million rather. This is a labor market that is growing so robustly that the Fed has a significant amount of work ahead of it still in order to kind of take some pressure out of the system.
We've got a couple of charts here. The first being core inflation, materially inflected in July. Explain a little bit what's going on here.
Yeah, absolutely. So this, in my opinion, let's take a step back and sort of talk about how we got here, how we got from S&P 500, 3,600 to 4,300, and I guess somewhere around 4,000 now off the drawdown. And then how do we go from Bitcoin 17.5 to, Bitcoin 24,000 or some thereabouts at the highs of this rally? The rally was first characterized by short covering and sort of vol targeting funds, kind of reducing their short exposure to risk asset markets. The second part of the rally, in my opinion, was perpetuated by fundamental developments, positive fundamental developments. One, we got it's a lot of information that said the U.S. economy was not only not going into an actual recession, but it was actually starting to reaccelerate in the month of July and in the month of August, whether it be the jobs report, the PMIs. Obviously, we got the August consumer confidence data today. This is gangbusters report. And then we got information out of the Fed from Jay Powell at the July FOMC meeting that said, hey, look, we're getting close to neutral. It might slow down. Obviously, our market misinterpreted that as a dovish pivot or something that sounded like a dovish pivot, but that's neither here nor there now. What I'm trying to do is explain why the markets got to where they got. And the third feature of why the markets got to they got, which in my opinion was the most important feature of the rally we've seen off the June lows across risk assets, was this breakdown in core inflation momentum. So to speak to the chart, what I'm showing in this chart, the light blue bars show the month over the trend rate of month over month annualized inflation for those inflation statistics. So we have trim mean CPI on the left. Next one is median CPI, sticky CPI, followed by trim mean PCE inflation. That's what consumers actually spend money on. And then the Fed's preferred inflation metric, which is core PCE inflation. So the light blue bars show where we trended at pre-COVID in the 5 years pre-COVID. The gray bar shows the prior month, so the month of June, and the blue bar shows the month over month annualized inflation rate for the month of July. And as you can see, we saw a significant deceleration across the board in these indicators of core inflation momentum. Trim mean CPI down 461 basis points in 1 month. Median CPI down 247 basis points. Sticky CPI down 270 basis points. And the most important statistic, which actually is the next chart, slide 83 I sent you, core PCE inflation momentum decelerated by 629 basis points in the month of July. So if you look at it on an annualized month over month rate of change basis, we went from 7.3% to 1%, 1%. And so this is very, very new. It's very important information because it says, hey, look, some of this inflation may in fact very well have been transitory, and it's now starting to break down outside of recession in a way that we've typically never seen before. In fact, there's only one other month in the history of this time series going back to the late 1950s where we saw such a significant deceleration in a 1 month time horizon. And of course, that was in recession. And so it's very unusual for us to see this kind of breakdown in core inflation momentum without a recession, which does lend some credence to the view that, hey, some of this inflation was in fact transitory.
The idea that we're still considering whether we're in a recession or not is wild to me. When we see these types of data points, though, does it just say, okay, transitory, not transitory? Obviously, there's no definition. Is it 3 months or was it 3 years? Like, what did they mean? But in terms of recession, is this just confirming what kind of the mainstream crowd thinks around 2 consecutive quarters of negative GDP growth? Now you see something like this and you're like, okay, there's pain here now that we're starting to see. And if this trend continues, it's only going to get worse.
Yes and no. Yes, if you wanted to anchor on this and say, aha, therefore we must be in recession, sure, go ahead, be my guest. I continue to look at a compendium of indicators, namely the tightness in the labor market, namely the positive growth we're seeing in consumer spending still on a 3 month annualized basis. We're still growing at 0.6%, which doesn't sound like a lot, but it's certainly not recessionary. You're seeing acceleration in disposable personal income growth, industrial production still compounding at 2.5% on a 3 month annualized basis. None of these types of statistics are indicative of us being in an actual recession. And another point I want to make, I actually made this point in my macro minute today, which is the growing divergence between gross domestic income and gross domestic product. The former being how much money the people in our geography are making relative to the amount of stuff we are producing and selling abroad. And that spread, somewhere around $977 billion now is in the 100th percentile of quarterly data going back to Q1 of 1947. If you look at it on a ratio basis, it's in the 100th percentile of quarterly data going back to 1947. So there's this massive spread between how much money we're making relative to the amount of stuff we're producing, which obviously started, going back to 2020 when we start dumping trillions of dollars into the pockets of consumers and businesses. But the real key takeaway I'm trying to make about this divergence between income and product GDP, which is if you net them out, which is what the NBER, we talked about the NBER a couple months ago, this business cycle dating committee that that defines recessions in the US. If the NBER actually averages out GDP and GDI, and when you average them out from a growth rate perspective, not only are they growing still, it's actually accelerating through the second quarter. So we're very clearly not in recession, from my opinion.
When you look at inflation, we've got a chart here that shows higher inflation begets higher inflation volatility. Explain what that means.
Yeah, absolutely. So this to me is again, we have a lot of very important questions to answer as investors right now. If we look out kind of 6 to 12 months, because again, I think the old playbook of Fed tightening, economy slows down, expect an earnings recession, expect an eventual Fed pivot, I think that's being challenged by the data. To be quite honest with you, if you think about some of the economic updates we've gotten for the month of July and the month of August, which clearly shows an acceleration off the June lows in economic statistics, if we're being honest. I'm always being honest with the data. I'm just not sure anyone else is paying attention. But the reality is, looking at this chart, higher inflation begets higher inflation volatility. So the blue line in the chart just shows the U.S. year-over-year headline CPI rate going back to January 1881. And we show the trailing 5-year volatility of that time series on a percentile basis on the right axis. And so what you typically see is when we have higher inflation, you typically have higher inflation vol, which is exactly what we're experiencing today. And so as we look out further in time, I think the next chart kind of explains what I mean by why we're looking at inflation volatility. Because again, when you have higher inflation volatility, when you have high inflation, you typically have higher inflation volatility, which typically leads to higher volatility in both nominal and real economic growth, which makes it harder to forecast. That's the key takeaway on, kind of expecting where we're going with this. I think we have to be a lot more data dependent than normal from this perspective. And so what I'm showing in this chart here, I'm showing on the x-axis of these bars are showing the inflation volatility, the red line in the previous chart, and I'm showing it in quartiles. So breaking it up in shares of 25%. And as you can see, the chart on the left just shows the volatility of S&P nominal earnings. And as you can see on a percentile basis, again, data going all the way back to January of 1881. And as you can see, there's a step function increase with the more inflation volatility you get, i.e. going from the first quartile to the fourth quartile, you get more nominal earnings growth volatility. And the same is true with the chart on the right. You get more real earnings volatility. And so the key takeaway here is, as investors, we should not be expecting the kind of linear processes. It's not to say that it won't happen. It's just that we need to be very aware that the kinds of linear processes that we're used to, XYZ happens with the Fed funds rate, XYZ happens with the Fed's balance sheet, therefore ABC must happen with earnings, growth, GDP, et cetera, et cetera. Those linkages break down when you have a lot more volatility in the system, economically speaking.
And then when you go ahead and we look at this last chart that we have, we're still talking about the kind of higher inflation volatility. It also leads to like PE multiples.
Yeah, absolutely. So you typically get multiple compression when you have higher inflation volatility. And it makes sense, right? Think about, go back to what we just said. Higher inflation begets higher inflation volatility. Higher inflation volatility begets higher nominal and real economic growth volatility. And as a function of that excess volatility and nominal and real economic growth, the market assigns a lower multiple to the earnings estimates and the earnings that they can see. And so what I'm showing in this chart on slide 12 is the price to trailing 12-month earnings ratio for the S&P. Again, this is data going all the way back to January 1981, or sorry, not 1981, 1881, over 100 years of data here. And then the chart shows showing that same analysis broken up by quartiles of inflation volatility, looking at the CAPE ratio, that's the cyclically adjusted price to earnings ratio, or the PE10 data from my former professor at Yale, Bob Schiller. And so what we're looking at here is understanding, hey, look, the more inflation volatility you have, the more economic volatility you have, the lower kind of multiples you should assign to asset markets. And kind of one key takeaway from here is, even if earnings can hang in there, which they very clearly did in the second quarter, if we're all being honest as bears, if the earnings can hang in there in this sort of higher nominal GDP kind of environment, because the Fed has yet to reach a neutral or sort of restrictive setting from the perspective of its policy rate, you still need to assign, not necessarily need to, but history would suggest that markets are still going to assign a lower multiple to those earnings because we're, again, in a higher economic and inflation volatility environment. So to me, it just sort of caps the upside in the bullish case scenario, whereby the economy doesn't experience a significant downturn because, oh, by the way, the Fed is yet to get too restrictive from the perspective of its policy rate. But obviously, we know what will happen to asset markets if, in fact, the Fed does go into restrictive, or we do see the slowdown in earnings and economic activity.
How do you think about inflation when we start getting into this like base effect where we know that, we were at more than 5% inflation starting in June, July of last year, ended the year over 7%. Now that we start seeing numbers like 8.5% in July, that seems like, it's come down, but actually it's flat on a month-to-month basis. And there's obviously this like base effect, and it's only going to get worse in the coming months. Like, how do you think through how that enters into kind of your calculations or evaluations of the market?
Yeah, great question, man. So in my opinion, I think the year-over-year inflation statistics are more or less irrelevant. And quite frankly, they've been irrelevant for 24 months now at this point, because what's really happening on the ground in inflation is we're experiencing, again, some of this very elevated volatility in the sequential rates of change of inflation. Historically, we were so used to, as a U.S. economy in the last couple of decades, really 3 decades, of inflation being somewhere between 0 to 0.1 to 0.2 max on a month over month, rate of change basis. We've been bouncing around between 3, 4, 5, 6, 4, 1, 1.5 in certain months. And so that higher degree of month over month, annualized inflation momentum is definitely contributing to, kind of a dynamic in the market whereby us investors, in order to really get a handle on these statistics, we actually have to look at it on a momentum basis as opposed to a year-over-year rate of change basis. And the reason I say that is because this is a market that is hell bent on taking the easy way out in terms of trying to front run the eventual Fed pivot. And you're going to be very late to understanding the kind of pivots the Fed is going to make in terms of their reaction function if you're looking at year-over-year rate of change statistics, because we're talking about year-over-year rate of change. We'll still be 4 or 5% a year from now on a year-over-year rate of change basis, but on a month-over-month annualized basis, 3-month annualized basis, you could very well be by that point in time back at 2%, which would give the Fed enough confidence that inflation over time will get there on a year-over-year rate of change basis. So what effectively I'm trying to say is look at the leading indicators, and the leading indicators are the month-over-month annualized rates of change, the 3-month annualized rates of change, because they're going to beat the year-over-year rate of change to the right spot that it caused the Fed to pivot, months ahead of time.
So we're talking about all of this in what I would consider a very focused view of the U.S. economy and obviously what's going on. If you were to talk to somebody like Zoltan over at Credit Suisse, he put out a piece last week talking about this idea that there's basically been 2 major alliances. There's been the U.S. and China, and then there's been Europe and Russia. And his belief is that those 2 alliances are falling apart. He called it a divorce, and now says, don't look at the BRIC countries, instead look at the tricks. And he basically calls out Turkey, Iran, Russia, China, North Korea, etc. And he's like, look, all these countries that are being sanctioned by the United States, they're starting to come together and work more closely, right? And what that exactly will entail is, not yet understood completely, but definitely they are starting on an economic basis, on a trade basis, on a military exercise basis. It appears like, hey, the enemy of my enemy is my friend. And so if that plays out, his thought process is that will lead to much more conflict in the world. And one of the strong arguments he makes is, well, there's been a lot of harmony in the world because of those alliances. And so we've lived in this low inflation world as like a major trend for the last couple of decades. But now, if we have a reversion away from those alliances, that means trust will decrease. If trust decreases, that means that people then begin to fight over resources, fight over supply chains and labor markets and all this stuff. And that will likely return back to a higher level of baseline inflation across the world. Now, I know that theory is highly complex, lots of nuance in there, but what is your general view of like a more macro trend basis if we kind of zoom out and say, like, is it a world where like maybe this low inflation world we've been living in, that's over and we should just expect to have higher baseline inflation globally in the coming years?
Yeah, absolutely. And so define lower inflation, right? I mean, are we going to stay at 9% inflation? Probably not. We're going to settle, in our opinion, at least according to our model we built, I think one of the more sophisticated models that I've seen in the world in terms of projecting the long-term trend of inflation. And that our model suggests it's forecasting an inflection for the first time in decades in terms of on an out of sample basis. And so that's noteworthy because we've been making lower highs and lower lows from an inflation time series perspective since going back to the early 80s. And so to forecast an inflection off the lows of 2020 is noteworthy in that regard. But more importantly, we're talking about, at least according to that model, which has 16 different factors that have been empirically proven to have fairly consistent correlation and co-integration with inflation. Things like deglobalization is one of the heavyweights in that model, which is obviously something that Zoltan is implicitly or explicitly speaking to. That model suggesting that we're probably going to have somewhere between 40 to 70% more trend inflation in the coming decade. Now, that doesn't, it sounds like a lot in percentage terms, but in reality, we're talking about, if you look at core PCE, for instance, we actually averaged 1.6% year over year in core PCE throughout the 2010s. The model is effectively saying we should average somewhere between 2.3 and 2.8%. Now, again, is this really like this massive move higher in inflation? No. But the reality is the trend level of inflation is shooting up by, roughly 100 on the high end, 110 basis points. Now, the reason that matters to asset markets and investors is because we're talking about somewhere close to 100 basis points more inflation on a trend basis than the Federal Reserve's target, their 2% target. And again, 2.8% inflation on a trend basis is wake me up when something happens, right? That's a yawn. But the reality is that extra 80 basis points matters because you have a Federal Reserve that's going to consistently see that and look at that and need to bang its head on its hammer on that. If it doesn't understand that we're in a new world, a new regime, whereby inflation not only is inflected higher on a trend basis, but is likely to be persistently higher than their price stability target.
I asked you this a couple of months ago, and you said no, but I want to ask again to see if you change your mind. Will the Fed potentially increase the Fed target rate from 2% to like 2.5% or 3%, given that we're going to live in a higher inflation environment? So they just say, throw our hands up, like we're not actually trying to get back to 2%, we're trying to get to 2.5% or 3%?
Not in this regime, not in this particular cycle. I do believe that is ultimately I think that's the most important question we all need to answer as investors and policymakers in this decade. I don't believe they're going to do that in this particular cycle. And the reason I say that, one, I spend a decent amount of time kind of reading the tea leaves on everything these people say. And it's very clear that they are trying to maintain whatever control they have over the bond market through the lens of depressed and negative term premia by being very forceful and very combative against the current inflation surge. Now, when we get to a state of the economy, eventually they're going to, in order to get inflation under control, if in fact most of the inflation is not transitory, which I would argue it's not. I think a lot of the transitory inflation we've gotten is starting to come out, but we're going to still wind up at a level that's much higher than their price stability target. And so once we get to that level, they will have to really kind of materially lean on the economy from a restrictive policy setting perspective and perpetuate a downturn in order to get rid of that last little bit of inflation. And it's at that moment where they're going to have to be faced with some very difficult choices. It's for lack of a better phrase, it shits and giggles when the unemployment rate goes from 3.6 to 4. It's no laughing matter when it goes from 4 to 6 or 4 to 7. That's a very, very different discussion at the Eccles building down there in DC where the FOMC gathers. So to me, I think when you're actually in a downturn, and they're finding it very difficult to go from, it's pretty easy to go from 8.5 to 5.5 or 8.5 to 4.5. But how do you get from 4.5 to 2? That's where the difficult questions come in. And I think at that moment, also to revise their inflation target higher.
Larry Summers, he says we're going to have over 5% unemployment for 5 years before we get inflation under control. Is he just laying out bombastic claims, or do you think that it is going to get pretty bad in terms of the unemployment rate?
Right now, no. I mean, so the market pricing on the Fed funds rate is somewhere on the terminal basis, somewhere around 3.75 to 4%. I'm not so sure how restrictive that is in this new economy. This economy is very clearly telling you that it has the ability to withstand higher rates. We still have positive growth on an average basis between GDI and GDP. We still have positive growth on a real basis in terms of consumption. We still have positive growth on a volume basis in terms of industrial production. And I concede the view that housing has really fallen off a cliff and probably should have, given the starting point And there's obviously some things that are breaking down the economy, particularly where all the lags in the economy. But the reality is, again, this is an economy that is growing nominally at 7 to 9%, double digits recently. 2.5% on the Fed funds rate is not restrictive. We're still technically in accommodative territory, which means the Fed is still kind of technically easing relative to the kind of growth potential in the economy. So they've got a lot of work to do on the policy rate front. And I'm not so sure that what current terminal Fed funds rate pricing is, that constitutes doing enough work to get that Larry Summers, view that we're going to have 5 years of 5+% unemployment. Now, again, if the pulse terminal Fed funds rate expectations go higher, let's say into the mid fours or even kind of mid to high fours, I think that by the time we get to that point, inflation will be down, nominal growth will be down. We'll be looking at a very different, more moderated economy. Then I think we'll be in a restrictive territory. But for now, this is where I don't even know if this is a worthwhile discussion today.
Yeah. My last question for you: what are investors doing differently than maybe they were a couple of months ago? How are they positioning their portfolios? What are you seeing with your clients that they're either talking about or they're actually moving capital to position themselves for the next couple of months?
So that's actually really interesting, man. And this is something going back to the beginning of our discussion, we talked about how we got, the rally was sort of catalyzed by systematic investors kind of changing their positioning, kind of unwinding some of the positioning we saw. But really, from a fundamental oriented standpoint, there was some real fundamental juice to this rally. As I mentioned, growth accelerated. We got earnings from Q2 earnings were, relative to expectations were fantastic. We actually saw some, pretty sizable beats by some very important companies. And so, we had a lot of very good news in the month of July and throughout the month of August. Not the least of which is the breakdown in inflation we discussed at the beginning of the program. And so from that perspective, I don't know that enough investors have really acknowledged kind of this sort of emergence of a potentiality of a Goldilocks soft landing, because again, to a person, to a firm, to an investment committee that I speak to, and we have, clients all over the world across, different, asset markets, different, pockets of the market, et cetera, different big firms, small firms, et cetera. Everyone thinks this is a bear market rally. And so do I. I still think we're in a bear market, but I don't believe we're in the probability of us being in a bear market, in my opinion, is much lower today than it was 2 months ago. And I'm not sure that the average investor acknowledges a lot of what's changed at the margin in direction of Goldilocks. Now, again, Goldilocks is not the modal outcome. It's just a much higher probability than I think the average investor realizes. And so I think the next couple of months of data are going to be very telling on the growth side. Can we maintain this sort of nascent positive momentum? And on the inflation side, can we maintain this very aggressive breakdown in core inflation momentum? If the answer to no is no, at least to one of those two questions, then Goldilocks will start to dissipate from a probability standpoint. If the answer to both of those questions is no, then we are very clearly still in a bear market, and we may, in fact, we have to retest the lows at some time this fall or winter.
Yeah, it's going to be fascinating to kind of watch how this plays out. But the idea that Powell's talking so tough and people are reacting is exactly what I think he wants. And so it'll be funny.
Recession. And I'm not so sure that is no longer the modal outcome. It's just that we all got ahead of ourselves in terms of anticipating it. This may actually very well be a summer of 2023 event when the Fed, in fact, does get the policy rate to a neutral setting, to a restrictive setting. Balance sheet unwind is actually, kind of pinching the economy, et cetera, et cetera. I just think we got too far ahead of ourselves with the 10s-2s curve inversion. One thing I call out, and one thing that's given me a lot of confidence, one, we're not in an actual recession. And more importantly, it's not something that we should be discounting at the current juncture, because we've yet to see the inversion in the 10-year 3-month track recession. Just kind of no CNBC and Bloomberg. The one that has a 100% hit rate from a historical perspective, 9 for 9, is the 10-year 3-month yield curve. And we're still positive 25 basis points there. So until that inverts, I think this concept that we're headed to recession and the economy slowing down really significantly, I think those are kind of, those are more for finance Twitter as opposed for, real economic and decision makers on Wall Street.
Makes complete sense. Where can we send people to find you or find out more about 42 Macro?
Yeah, appreciate it, man. Thanks again for having me on. Always a pleasure to come chop it up with you, my friend. 42macro.com. We produce what I think is some of the world's best institutional macro research for everybody. So we have, clients that manage trillions of dollars. We have clients that manage hundreds of thousands of dollars in their PA. So come check it out. We help investors construct thoughtful portfolios to take advantage of the full range of probable outcomes from a macroeconomic standpoint, policy standpoint, et cetera. I know what I'm doing here. So we're excited to come check us out. And by the way, if you can afford the research, I think it's very reasonably priced. I do a lot of free research on Twitter as well at 42 Macro Details. So definitely come check us out.
Awesome, my friend. I appreciate, as always, you coming on. You have not only unique views on the market, they're backed by data, and you do a great job articulating them. So we'll continue to do these every week, and hope that everyone's learning a lot from it.
Looking forward to it, man. Thanks again. Appreciate you.